We're doing a program today on gift consequences. What are the consequences of making or receiving a gift? But mostly this is about making a gift. Friend here, Mark Worthington from Special Needs Law Group
of Massachusetts
is here with me. Mark has been Mark really knows tax law very well. You were the director of the federal tax. Go ahead. You introduce yourself.
Oh, I'll introduce myself. Well, hello, me. Yeah. So amongst the things that only my mother cares about, I have an LLM in tax from BU, as does Brian. That's a law degree, in case you don't know, on top of a JD. I was director of the LLM program at Western New England University Law School in elder law and estate planning, and I've been teaching there. Excuse me. Also as an adjunct, and I've been teaching there since 2005. Although I'm a mere adjunct now, I'm no longer a full-time professor there. Certified elder law attorney, like you, Brian. I don't know what else.
That's good enough.
Lots of stuff that nobody cares about.
You're qualified to talk about these tax issues. So the way we've divided this up is I'm going to deal with government benefit kinds of issues, and Mark, chime in if I say something that's too broad or too narrow. And Mark's going to deal with the gift tax and the state tax issues. And there are some other tax issues floating around in there. So we're going to start small with smaller gifts and work our way up. We only have a half hour. So let's get rolling. So what the first question is, what are the results if an unmarried person makes a gift of $16,000 to a child? Let's start with tax.
Sure. So on its face, what happens is nothing. It's a gift. There's no gift tax on it because the federal annual exclusion amount for making gifts is $16,000. But what you didn't say in your question is that the only gift that year that was made. So assuming that it was $16,000 and that's it for that calendar year, that's the only gift from that donor person, the parent, to that donee, the child, then it's completely covered. There are other things that go along with it, which we'll talk about later, like carryover basis, I imagine we'll get to. I do want to toss in a couple of quickie points, though, that, we hear that people say things like, oh, I know I can't give away any more than it was $15,000 last year, now $16,000. Well, sure you can. You can make gifts of any amount. The only issue is, what are the consequences? Most people, I think, are surprised to learn that there is such a thing as a gift tax. There is federally, not Massachusetts though, but it does have an impact anyway on Massachusetts estate tax. The annual exclusion amount was designed to be take into account ordinary life. It was not designed so that you could make all kinds of birthday gifts and holiday gifts and stuff, and then write a $16,000 check to that same person. Creation of joint tenancies can be a subject to the gift tax. And I think maybe one of my favorites is when somebody says to me, "Oh, I didn't make a gift. I sold that property to my son for $1." Well, IRS didn't just fall off turnip truck, pardon me. So yeah, they know that you made a gift. So, all right, that's my little answer there.
So does the recipient of that $16,000 gift get taxed?
No.
No. Okay.
One thing that's but look, it's really important to understand something. In tax law, if I get something, it's either a gift or it's taxable income, but it's never both. It may also, in some cases, simply be a return of principal to me, like, if I'm getting an annuity payment, part of that's return of principal. But something will not be both a gift and income. And in this case, it's a gift.
Okay.
Brian, I'm supposed to remind you disclaimer stuff.
Oh, well, we're talking in general here. No one should, rely on everything we're saying as though it's legal advice that applies to you. I mean, we're trying to cover a lot of different issues here.
Right. So we necessarily have to leave out some details that may matter for your particular circumstance. And most importantly, we're not your lawyers. Even if one of you listening is a client in this session, we're not your lawyers. We're not giving you legal advice.
Okay. So now we're going to take that $16,000 gift you made to a child, and I'm going to run through some of the government benefit programs very briefly. So first, I'll just quickly say there are certain housing programs like elderly housing where you're not penalized for making a gift, but it's for the next 2 years, they impute income from the asset that you gave away as though you hadn't given it away when they're calculating your rent. I'm going to leave it at that. There are probably other housing program issues out there. If you're dealing with housing, you got to really dig deeply into that. SSI, if you're on SSI and you make a gift, we take the amount that you gave away, we divide by the amount you were receiving, and you're penalized for that number of months. They round up. The penalty starts running the day or the month after the gift, but for a maximum of 3 years. MassHealth, this is the big one. Any gift you make can cause a penalty period. Now, the rule is the state is supposed to calculate what the average cost of nursing home care is. They are doing a job of keeping the number low by the way they're doing it, and they're claiming it's $410 a day. So you give away 16,000, divide by 410, round the number up, you're disqualified for 40 days. The 40 days, though, doesn't start when you make the gift. It starts when you're otherwise eligible for MassHealth, which means you're practically out of money. Effectively, that means that the recipient of the gift has to either give it back or pay for the facility for that period of time if you're in a nursing home. I think you'll find in many cases that the cost of the nursing home for that 40-day period would be more than the gift. So a lot of times it makes sense to just put the money back. Finally, the VA Aiden attendance program. This is something that a lot of people don't know about. It's for wartime veterans. Generally speaking, you didn't have to serve, except for the early part of the Vietnam era. You didn't have to serve in the war as long as you served during wartime. There's an amount that a married veteran can get over $2,400 a month if you're homebound and you have essentially a cash flow problem. The surviving spouse can get over $1,300 a month. So this is a really good benefit that a lot of people don't know about. About 4 years ago, Congress put in a penalty for making gifts, and it's very complicated. There's a 3-year look back. Usually when there's a look back period in a government program, that's the maximum penalty period, or often that's the maximum penalty period. But here, there's a 3-year look back, but the penalty can be up to 5 years. So they take the amount you gave away, divide by a number that changes every year. It just changed. But they only look at, there's a cap on how much you can keep. And right now that number is 138,489, excluding your home. So you make a gift of anything above that, they divide by 2431, and that's the number of months that you're penalized for. This benefit rounds down. So, there's every one of these programs has a different rule. Round up, start next month, start last month. You can't rely on anything you hear, and you can't apply what you hear about one program to another. that is a quick summary of VA aid and attendance, but it's really something that people should be looking at if they're eligible for it, because it's essentially free money. It can help keep somebody at home or in assisted living. Mark, do you want to add anything about that? Any of these things?
Just real quick, we focus a lot in our conversations on MassHealth for nursing home care, but
Okay.
most people on MassHealth, they're under 65 and they're not on a certain kind of MassHealth called home and community-based waiver services. So if you're kind of just on plain vanilla MassHealth and you're under 65, there's not only no asset limit on what you can have, that there are income issues, but no asset issues. And at the same time, since there's no asset issues, they don't care if you give away anything. You can make gifts without penalty for those kinds of MassHealth.
Right. Great. Thank you for clarifying that. So on to the next type of gift. Now we got a married couple giving away $34,000 to a child.
Okay.
Your turn.
Oh,
tax
my
issues.
turn again. Okay. Well,
Back
both spouses have the $16,000 annual exclusion that they can use. So it sounds kind of easy. It's like, hey, fine. That now our limit is 16,000 times 2, right? Which is 32,000. So we're in excess by $2,000 here, right? So they can, if they were, let me just quickly say, if they were under, say they wanted to give away 30,000, they're within the exclusion, but the IRS has some weird rules about, quote, gift splitting. So if they each wrote a separate check for, $15,000, they're fine. If they don't, if one spouse decides to make the gift of $30,000 from that spouse's separate account, then the IRS wants you to file a gift tax return the next year, a Form 709, IRS Form 709, and both spouses have to file it, and both spouses have to assent to the, quote, gift splitting in order to make that work. Question is, what if one spouse writes the check for 30,000 and it's from a joint account? I think the answer is still the same, but most people don't. I think most people don't care. If it's from a joint account, they don't care who writes the check. This one was for $34,000, so you've got a $2,000 excess amount. Or if there's no consent to gift splitting, you've got $18,000 excess amount. And a Form 709 needs to be filed by April 15th the next year, reporting the gift. So you have the amount that's excluded. Let's say it was $32,000. The other $2,000 is a taxable gift. If you're electing gift splitting, that would be $1,000 per spouse. And what's the effect of that? Well, there is a gift tax payable, but only if the gifts that you make in excess of the annual exclusion and a couple of other exclusions exceeds during your lifetime $12.06 million per individual. God bless you if you have that problem. The effect, however, of the excess amount here, $1,000 per individual, per spouse in this case, is there's no tax due now because you're using up that $12.06 million exclusion. But the effect is, in this case, to reduce for each of the spouses the amount that they can pass free of federal estate tax by $1,000.
Wow.
Yeah.
Let's get to the mass estate tax. How does that?
The mass estate tax is weird. So if you're making tax, so Massachusetts has no gift tax, period. But it does affect the mass estate tax. And the way it does it is this. Let's say that you had, I'm going to just change the example a little bit. Let's say you had a single person, $1.1 million. The mass estate tax threshold is $1 million. Got to pay tax on anything over that when you die. Well, if you gave, so let's say this individual gave away $200,000, brings their estate down to $900,000. Well, when they died, they gave away $200,000. Now their mass exemption is no longer $1 million, it's 800,000. The effect of it will be to slightly lower the amount of estate tax that they will have to pay. But it didn't get rid of it just because they got their estate under $1 million.
All right, we're gonna get back to another example of that later on. So let's go on to MassHealth. Everything the two of us said about MassHealth before is the same on this gift. A gift by one spouse causes a problem for another spouse if we're talking about long-term care. There's something known as a cure. If the child receives 34 grand, and one parent goes to a nursing home, there's going to be a penalty period. The child can give back the money, but the regulations say the money has to go back to the parent who made the gift. So if you give the money back to the wrong parent, it may not fix the problem. It's one of those strange things in MassHealth. MassHealth is full of strangeness. All right, so moving on, Mark, to what are the results? Unmarried person pays education and medical expenses directly for a child. And then I'm going to throw another twist in there and say, what if the parent reimburses the child for those expenses?
So if this is called the unlimited med ed exclusion amongst us who do this sort of stuff for a living. And it means that you can pay for any person, not just a child. You can pay their tuition, not books, not lab fees, tuition for any education. Doesn't have to be higher education. It can be, tuition for kindergarten or whatever. Or medical expenses, and that includes health insurance premiums. You can pay for anybody in any amount. And shall I anticipate your next, what you said? Like, what if you say, oh, well, my kid already wrote a check for the tuition. I'll reimburse my kid. That fails. The payment has to be directly to the provider, the educational institution, the medical institution, the health insurance company.
Okay. All right. The MassHealth result here. Well, it's still a gift. MassHealth can still penalize you, but there is an exception in the MassHealth gift rules that if you do something for purposes other than planning for MassHealth, it can be accepted as an acceptable gift. It can be now. So,
but be prepared to duke it out with MassHealth on that.
Right. Well, people, for one thing, if you're paying someone else's medical bills, then there's probably a problem there. And the people some of the hearing officers will look at that. Some, when you file an appeal, it's just sort of a crapshoot. You enter the lottery. You might get a hearing officer who likes people, and you might not get that kind of hearing officer. So if it was inadvertent, you need to come up with evidence. All right, so let's move on. Unmarried person deeds a $500,000 house to a child. Tax consequences.
Well, in terms of the gift tax issues, we already covered that. Okay, that's all the same. It does qualify for the annual exclusion, et cetera, et cetera. No federal gift tax unless you've already given away close to $12 million, et cetera, et cetera. By the way, that $12.06 million number for federal gift tax and estate tax exclusion, if nothing else changes, the law reverts that number back on January 1, 2026 to around $6 million. So be aware of that if your net worth is high enough to care about that sort of thing. Now, if the house, so you give that, and one of the things that happens is that the donor, the parent, now no longer qualifies for the $250,000 capital gains tax exclusion that you can get if you sell a home, your primary residence, and it's been your, well, it doesn't have to be your primary residence at the time, but if it has been your primary residence for 2 out of the last 5 years, and you've owned it for 2 out of the last 5 years or more, then you get this Nido-Keene exclusion. So the only way it would qualify after that transfer would be if at the time of the sale, the donee child met the 2 out of 5 year qualification for primary residence and ownership. Now, another thing to know is that if you do that, if you just give away this home outright and you're out of there, then you've made a completed gift for both gift tax and estate tax purposes. And then when you die, that home does not get what's called sometimes a little inaccurately the step up in basis at death. So the any appreciation that there was is going to be taxed when the child eventually sells. Now, there's an exception, one exception to that, which is that if you just keep on living in the house, you have retained the possession, in fact, not a legal ownership right, but you retain possession. And if you move out of that house and stop using it as your own, and you do so within 3 years of your death, it will be includable in your taxable estate, and it will get the step up in basis.
Okay. All right, MassHealth issues on this. MassHealth long-term care. It's a gift. It's $410 a day. The amount given away divided by 410, that's the penalty period. But if a child is considered disabled, which means eligible for Social Security, disability, or SSI, or is a caregiver who's lived in the house under, and MassHealth has certain strict regulations on that, then that can be accepted. It can be an exception to the law, to the gift, to the gift
penalty.
rule.
Yeah, penalty-free transfer.
All right, so we are almost out of time. A gift of a $500,000 home to your spouse. That's not taxable. If your spouse is a U.S. citizen, if you and your spouse are a U.S. citizen, you don't have any problems, and MassHealth doesn't have any problems with that. I think the problem here is, what if one of them is not a U.S. citizen? Go ahead, Mark.
All right, yeah, sure. If the donee spouse is not a U.S. citizen, and the transfer was made on or after July 14th, 1988, then you don't have an unlimited gift tax marital deduction. Instead, you have an annual exclusion for that spouse, but the annual exclusion amount, instead of being $16,000, is $162,000 this year, and it's adjusted annually for inflation. You also need to be extraordinarily careful about creating joint tenancies where the United States citizen spouse takes an asset and now changes the ownership so it's held jointly with a non-U.S. citizen spouse. And non-U.S. citizen, by the way, think broadly. It doesn't just mean somebody from halfway around the world. It can be somebody from Canada, which we see a lot, and who has never become a U.S. citizen. So we won't get into the details there, but it can be like if there was a establishment of a joint tenancy in a bank account of $500,000, that would be a gift of $250,000 immediately to the non-U.S. citizen spouse, but only $162,000 of that is covered by the annual gift tax exclusion. And what couple doesn't, as a matter of, the vast majority of couples is an ordinary course. They're not keeping track of this stuff. This money going here, money going there, opening this account, closing that account. They can rack up an enormous amount of taxable gifts in the process of doing that. What I just said does not apply to establishing a joint tenancy with a non-U.S. citizen spouse if the asset is real property. No gift has been made at all.
All right. So we got one last example here, and then I'm going to quickly talk about trusts at the end. What if an unmarried person or a married person gives away 2 million in appreciated stock to a child? We've covered a lot of this. I think the point of this is to stress that there's no mass gift tax. But go ahead, Mark.
Yeah, sure. So here, like if we just have this single individual gave away $2 million, what it does is that it reduces that individual's ability to pass assets free of federal estate tax by $2 million ish. I mean, some of it would be subject to the $16,000 annual exclusion. And so really for federal estate tax purposes, what it would do is it would reduce the estate tax exclusion of 12.06 million. It would reduce it by $1,984,000. The mass estate tax, this would reduce the threshold for mass estate tax down to, I think, it bears to say, I can't remember. It's either $60,000 or $90,000. I think it's 90. And so if this person, for example, was married, should I go into that?
Sure. Go ahead.
Okay. This person was married. They could leave $90,000 to any old kind of a trust or to a kid or something like that. And if the rest of it was left to the surviving spouse or left to a marital deduction trust for the surviving spouse, the mass estate tax would be zero on that individual's death. And then the surviving spouse can eliminate the estate tax by the expediency of moving to Florida or any one of a number of other states where there is no state estate tax. Let's see, did I? The other, basis. Yeah, so basis, all right. So let's just talk about basis here. I don't think we really need to hit the married person scenario, right? This is just, So when you give away an asset, you give away three things. You give away the asset, you give away your basis in the asset, meaning if you sold it, what would be excluded from determining the capital gain on the asset. And you also give away whether or not the asset has been held long-term or short-term, which can affect the tax rate. The other thing I wanted to get into there is that sometimes people give away assets that are underwater, meaning that the basis, what they paid for the asset or their basis in it, is greater than what it's worth now. So that if you give away an asset that you paid $100 for and you give it away when it's the stock's gone down or whatever, and it's now worth $60, you give it to your kid. If your kid turns and let's say the market goes up to $80, your basis for determining loss is $60. So you didn't get a carryover exactly.
Right. So somebody who wants to give away stock that's down in value should sell it and use the loss on their own return.
Yeah.
Right.
And then give it away.
Yeah. So typically somebody's not giving away. Now I'm going to deal with MassHealth very quickly. Typically, you're not giving away $2 million in appreciated stock to try to get on MassHealth. But there could be someone with maybe a long-term diagnosis of Alzheimer's who's going to make large gifts like this. So you have to sit down with tax professionals about this, because sometimes it makes sense for the parent to sell before giving it away. And sometimes it makes sense to give it away. Now the child can pay for the parent's care, and can potentially treat the parent as a dependent and use all the payment, many of the medical payments, as itemized medical expenses. So when you're doing this kind of planning with large amounts of money, you got to look at that before you do anything. All right, so we're just about out of time. A lawyer I know, I think was interested in joining and watching. And after I had the outline, he sent me some questions about gifts to trusts. So that's a whole nother, another webinar. I mean, dealing with trusts. But generally speaking, if you make a gift to a revocable trust, that's still you for tax reasons. You didn't really make a gift, a taxable gift. If you make a gift to an irrevocable trust, many times that is a gift. But if you keep certain powers over the trust, it might not be a gift. If you set it up in trust for your spouse, that might not be a taxable gift, depending on how the trust is structured for your spouse. Is that enough, Mark? I think
just the big thing people should know is that if you're making a gift to an irrevocable trust and it is a completed gift, usually, not always, but usually it does not qualify for the annual exclusion.
Right. Okay. Well, Mark, I think we did it. We didn't cover everything. So
No, we didn't.
whoever's listening or this is going to be, this is being recorded, so somebody might be watching afterwards. This is the law as we know it on January 20, 2022. I mean, Congress can change laws, Massachusetts can change laws. But you got to, before you make a large gift, you got to look at all the consequences, and that's the bottom line. Thank you for joining us, Mark. We'll do it again on some other tax topic in the future.
Okay.
Thank you.
Bye-bye.
Bye.